Right, now in this task 4.22, I just want to help you around the depreciation, because this is often a problem because there are so many aspects involved in it. Now, if you look at the information, you're told that we've been given some balances on the 28th of February 2006. And if you look at, you've got your vehicles and equipment, that's the cost price, and you've got accumulated depreciation, but take note the date. So in other words, we are now working with a year over here that is running from the 1st of March 20.5, and that was the last time that any depreciation on these assets were written off, and we're working to the 28th of February 20.6. Right. Now the first one says to us that additional equipment was bought on the 31st of August for 14,000 and has been recorded. Now this is the important thing. It has been recorded. It means it's already been added into equipment. So if you look up here, that 84,000 already includes the 14. So if we bought on the 31st of August over here another 14,000, and that already includes the 14, the 84,000, that is your figure at the end of the year. So you're going to have to work backwards to get the figure at the beginning of the year, which was 70,000. And the reason why we do that is because it has been recorded. Compare that to the next one. An additional vehicle was bought on the 31st of December, but has not been recorded. So in other words, in that case, that vehicle's of 260 is the beginning of the year figure. You're then going to add on another 40, and you'll have 300,000 at the end. Now that's going to affect the depreciation on the vehicles. But right, let's just carry on with the equipment. In point number 3, some equipment was sold, and we're selling now on the 30th of November. That's when we're going to sell. So we know we've got to do asset disposal, putting through here. We are given the cost price of 30,000. We're given the accumulated, take note, the beginning of the year was already 12, and then its selling price. And then in point number 4, we're told that equipment is depreciated on cost. Now, it's this calculation. And what you've got to look is that you've got 3 pieces of equipment here. The first thing is that of this opening balance here of 70,000 Rand that you had at the beginning of the year, you have not kept that all for the year. Some of it has been sold, and some of it was kept. Now this 70,000 is your cost price, and if you look up here, the cost price of the asset you sold was 30,000. So if I subtract those two, means I'm left over with the second piece of equipment for 40,000. How do I know it's still there? Because there's no mention made of it. But then we bought another one, and we bought another one for 14,000. So here's the 3. The one you're selling, the one you kept, and the one you bought. And because of the time periods, you're going to have to work out the depreciation separately. So the one that I sold over here, yes, the depreciation is 15%. I am selling it on the 30th of November. So I've had that for that period of time. And if you work that out, that is a period of 9 months. So your depreciation there will be 3,375. The 40,000 is also 15%, but we've had it for the whole year because there's been no mention of it in any other way. So your depreciation would be 6,000. The 14,000, also 15%, but you've only had this one for this period. No, you didn't have it for that. You've got it for this period of time. This is the 6 months that you've had it. You did not have it there, so you can't put depreciation for that period. But you've had it for that 6 months. So you're going to have to depreciate by 6 months here for the period of time that you had it. And that comes to 1050 and gives you your total depreciation of 10,425. All right, so what am I saying to you is when you work out depreciation in these fixed asset notes and asset disposal, break up the asset into different aspects. What did you sell? What did you keep? And what did you buy? Right, now, this one was worked out on cost, and that makes it relatively simple. Or should I say it's simpler than the diminishing balance. If in this one, this had been on the diminishing balance method, then you would have still looked at the opening balance, which is still 70,000. Remember, we got that over there. But because we're on diminishing balance, we know that this equipment had already been depreciated up to this point in time by 42,000. So if we had to subtract the 42 here, we would have had a book value here of 28,000. Now remember, the reason why I'm doing this is I'm assuming that they're going to ask you for depreciation on a diminishing balance. And you are going to get this. It is more challenging. So the first thing, because it's on diminished, you need to work out the diminishing balance. Then, again, you need to work out and say, right, what was the diminished balance of the asset I sold at the beginning of the year? And that's this here that they gave you. They told you the original cost was 30, and up to the beginning of the year it had already been depreciated by 12. So if you take that away from each other over there, that gives you an amount of 18,000. So the bit you sold was 18,000. That is the carrying value or the book value as it was at the beginning of the year. Now, you've only got an amount of 28,000 here. 18,000 is on the one that we've sold, and that means that the one that I've kept is 10,000. That's the book value. Remember, I'm working with book values here. And then the new one that I bought, obviously this has never been depreciated, so that makes no difference. So your sold one, it's still going to be 15% if we're working out diminishing balance, and you still had it for 9 months. The one that you kept will be 15%, and the new one is going to be 15% times 6/12. Now that's not the figures for this. Remember, learners, I'm just explaining for another exercise. So the important thing is, if it's on cost, then you're working with the cost figures. What was the cost of what I sold? What was the cost of what I kept? And what was the cost of what I bought? If it's on diminishing balance, then you need to get the diminished balance, the book value of the equipment at the beginning of the year. Then how much of that is on the asset you sold? How much of that is what you're keeping? And then the new. It's this extra step that you've got to remember.